Hello traders, Gary Wagner here. It is 8:45 in Honolulu, Hawaii. It's Thursday, the very first day of September, and this is the daily report for gold. Gold is trading quietly this morning. In terms of its range, it was down a few dollars in overseas trading last night to up $1, $1.50, currently trading at 1827.99, call that 1828. And what we have going is as follows. In terms of some straight fundamentals, everybody right now is anticipating what we will see in terms of a job report, the U.S. economic data that's going to be released tomorrow. Of course, we are going into, on the mainland, an extended holiday. That would be Labor Day up until Monday. So the sentiment is we've still got a majority of the traders that are out for the summer and that are awaiting return. First chart that I do want to take a look at today is going to be our shorter term 120-minute chart. It is in straight candlestick format. I'll bring that up for you right now. If you recall, yesterday we took a look at a potential for a pennant formation. I'm going to go ahead and draw that in for you. But we looked at the fact that we had these series of highs and the lower high, which gave us our upper resistance. Our support was drawn from here. And as you can clearly see, we have broken through the apex, but without any energy and without any power whatsoever. Kind of a meek breakout. I would say no breakout at all. Traders, the next chart I do want to take a look at, since we are coming close to the conclusion of our week, is a weekly straight candlestick chart. And looking at this chart this morning, I saw a very, very interesting observation. Of course, we've talked about on many of our shows the fact that as we had this market trading higher, it was trading within a defined parameter, and that parameter could be found within our channel lines. Now, what I noticed was this: when the market broke above that, and this is that major breakout, if you take a look at the following week, and this is the week, of course, that we hit a new record high, 1913, and a low of 1703, so a $200 range within a week. That created this rickshaw man. But here is what I find quite fascinating. Take a look at this low right here. Do you see how it found support and matches up quite eloquently right at the top of that channel line? My sentiment is we can look at that channel line right now to provide extreme support in the market, so that even with corrections in play, my sentiment is that this line, this support line here, which used to be resistance, should provide the type of support technically needed to keep that market above that price target. The last chart that I do want to look at on today's show is a 720-minute candlestick chart. This is a candlestick chart we have been using, which contains our master Elliott wave count as well as a couple of key Fibonacci retracement areas. And what you can see in this chart is that this resistance that we have at around 1831, which is absolutely matching up with a 23% Fibonacci retracement, has provided very, very strong resistance. Now, you can see where the market's attempted to breach that on a few occasions. Realize you've got 2 bars for every day with this type of a chart. But the main point that I do want to make, again, is going to be, if we in fact do see this market correct, I believe that we would have confirmation of that as long as it stays underneath this particular line. So it's become quite clear to me that the 1830 area has become a very, very critical area. A break above that point would signal one particular scenario, and the fact that it has not been able to, and that's become superlative resistance, is what is leading me to believe that we still have another corrective leg or wave down. Now, where could that wave go to? Where would that wave go to? And in terms of a straight Elliott wave pattern, when we take a look, we've got our A, our B, and C in a normal correction would actually go below A. Now that would put it well below 1700, maybe 1680. The other two possibilities are truncated and flat. A flat would simply have a low that's equal to that of A, and a truncated, of course, would have a low that was higher than A. My personal sentiment, and this comes because I do have a fundamentally bullish bias, is that what we'll probably witness is a truncated corrective C wave. So where do I think that might go? And that's why I brought this chart up. We have a major Fibonacci harmonics. In other words, we have 4 different sequences. They're all going to the same high, the record high at 1913, but they're starting from different lows. These are the 4 points, as you can see on the screen right now. When we put those together, you notice that at this point, and this point is right around 1745, 1739, 1744, and 1742. So all 4 of these retracement sequences using different time sequences have really pointed out that this particular target area, this price point, is absolutely critical. Now, when we look at it, you can see this is also where we have our double bottom, right here and here. Therefore, my belief is, should we get a final leg of this correction, my sentiment is I would look for the market to basically test this area and, I believe, could possibly find support. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange